I think part of it was that, you know, Bitcoin was so beaten down by the whole, crypto fraud, FTX, all that stuff that happened last year. So if anything, it was earlier this year, you had kind of had a partial recovery just because you had super oversold levels. You had a lot of kind of long-term people kind of coming into the market, buying it, pulling it back up.
Bitcoin is the best performing asset of 2023 so far. It comes at no surprise because people are starting to realize that Bitcoin is the hardest asset on the planet, and there are more and more Bitcoin holders every single day. Crypto family, welcome back to the channel. Aaron here coming back at you with another cryptocurrency video. And you guys just saw on that clip, that was Lyn Alden. And in today's video, she's going to be talking about the banking crisis and how it plays in with Bitcoin. She also talks about some of the recent Bitcoin price action, why it happened, what's happening next. And she also talks about how liquidity will really affect Bitcoin going forward, especially in 2023. And if you don't know who this is, Lyn is the founder of a very successful equity research and investment strategy firm. She talks about a lot of great things in today's video. I recommend you guys watch all the way to the end. Hope you guys can learn something in today's video. If you guys are new, please consider subscribing. We have new crypto videos coming out every single day. If you want to get access to the Bitcoin Bros exclusive content, check out the Patreon link in the description below. But let's go ahead and check out what Lyn has to say here.
Yeah, the main difference is that this is more of a duration challenge compared to a credit challenge. So back in 2008, going into that event, you had basically generationally low cash and safe assets on bank balance sheets relative to their riskier things like loans, things that can actually default. And obviously, they did run into a default event, so they risked their whole bank capital getting wiped out by these series of defaults. And it looked in many ways very similar to the 1929 crisis in terms of, say, the how much bank loans were outstanding relative to the monetary base. These kind of like these big generational charts in the quantitative data. And so that whole the 2008 crisis and the 2010s aftermath were in many ways very similar to the 1929 crash and the whole 1930s aftermath, which is, going back to Neil Howe, that's, basically the fourth turning type of environment. This one's different in the sense that it's at least so far, there are certain pockets of credit risk. But the main thing hitting banks is that ironically, they invested in very safe assets, but at wrong prices. And now they're facing, their deposit rates going up. They're facing unrealized losses. And then they have a challenge where they can hold those assets to maturity, but the market doesn't always let them do that, especially if they have deposit runs and things like that. So earlier, last month there was a liquidity crisis. Now I think it's evolving more towards a profitability problem because, while the Fed and others have these facilities in to prevent ongoing liquidity, or at least reduce the severity of some of these ongoing liquidity problems, banks now face an issue where, they have some of these long duration assets that might be relatively safe, and many of them are, but then they have rising deposit costs overlaid on top of that. And if you look at the Federal Reserve's own balance sheet, I mean, they're in the red. They're operating at a loss now because their liabilities adjusted upward very quickly. That's a policy they decided to do, and essentially we're seeing the slow motion version of that happen to the commercial banking sector, where their deposit side is slowly kind of catching up with a big lag compared to where the Fed's own rates are. And you see that more so happening in the long end of the medium and smaller banks, whereas larger banks have more overall position to not really raise rates as quickly because everybody wants an account at those bigger banks. And so right now there's a kind of, I think, an ongoing profitability problem among those small and medium-sized banks. And then it's obviously further exacerbated by some areas of actual credit concern, things like autos, things like commercial real estate that are well-known issues at this point. So the TGA is already getting pretty low, the Treasury General Account. Yeah. And so basically what the way this all works is they've already started taking extraordinary measures. It's like if you lost your income source and you can't, tap in your credit cards, you have to start drawing down your existing cash balances in order to pay your liabilities. And so that's what Yellen's doing right now. They're supposedly going to get an increase, in these next couple of weeks due to tax season. That's possibly overstated due to how poor most capital gains were, over the past year. So we'll see the magnitude of that. The debt ceiling issue might strike more quickly than Yellen has previously estimated. I'm sure there are a lot of people doing really deep research on that. But I think essentially that is a huge catalyst to be aware of because ironically, it's not necessarily the debt ceiling to focus on, it's what happens right after it. When they resolve that debt ceiling and the Treasury tries to raise their cash balance back to their normal target level, that's a huge liquidity withdrawal
Yep.
out of the financial system that is already very tight on liquidity. So, autumn of last year basically was kind of a partial turning point in liquidity because for most of last year, you had the Fed drawing down their balance sheet, and that was obviously pulling a lot of liquidity out of the market. But then starting in the later part of the year, you had the Treasury really begin to offset that to a significant degree. They were pushing liquidity back into the market while the Fed was pulling it out. And so you actually had somewhat neutral liquidity conditions overall, kind of this choppy sideways, kind of stagnant liquidity environment. And if you get to the end of that, where the Fed is still trying to draw down, and now the Treasury is trying to refill its account later this year, that's a double negative whammy for liquidity, and it might cause one or both of them to have to course correct. But the path between there and here and there, I think, is going to be fraught with volatility.
Yeah.
Well, I think partially you define your time frames first of all. And so basically, some people what they do is they put Bitcoin in a different segment where they say this is something I'm not going to touch for a certain period of time. Kind of like how if you have physical gold in your house versus say a paper gold in your portfolio,
Yep.
you might treat them differently. You might say that the physical gold, I'm not going to worry about the price. I'm not going to worry about timing anything. Whereas the paper gold, I might try to do that.
Yep.
I think this is the same for Bitcoin. I think there's, if you define yourself as a Bitcoin trader, you want to focus heavily on things like liquidity. I've done a lot of work on trying to figure out what are the main factors that are the strongest correlation with Bitcoin price. So, historically, one of the ones is the halving, but that's actually not really good for a specific timing purpose. Generally, liquidity and economic indicators are better. So, if you put it simply, if you buy Bitcoin when the PMI is rising, you're going to have a better time than if you buy Bitcoin when the PMI is falling. And if you want to get more precise than that, if you look at various liquidity indicators, they generally front run PMI a little bit.
Yep.
And Bitcoin also tends to front run PMI a little bit. So actually the closest correlate that I've generally found for Bitcoin is various measures of liquidity, both domestic liquidity and then global liquidity, including, say, dollar denominated global M2 in rate of change terms. Those are the types of things that correlate heavily with Bitcoin. And so in any sort of like near-term environment, if you're trying to judge what it's going to do in a multi-week or multi-month period, you have to generally have a decent view on what liquidity is going to do. Whereas long-term, you can look at things like, what percentage of the supply is liquid versus like tightly held. What are the developments happening on that whole ecosystem? So what is making Bitcoin better to use, better to interact with? What are the other technologies kind of building on that whole stack? And so the way that I view Bitcoin is I have this kind of long-term holding, this very long-term structural view that I occasionally check to make sure that thesis is still in place. But then I use the shorter term stuff, the cyclical stuff, to one, manage position sizes, and then two, set expectations in a near term. And so, for example, I would use during this past cycle, I would use GBTC as a way to, get in or get out, kind of change my position in that sense. Whereas, like, say, cold storage Bitcoin, I treat more like physical gold, where it's something that you have a structural view on that you almost hold as a separate category.
So here's that PMI chart that Lyn was talking about there in that clip. And as you can see, this shows you when liquidity goes up and down. And this has corresponded to Bitcoin's price very closely. As you can see right here in 2015, it was hitting a low for the PMI. If you look at the Bitcoin chart here, we can see back in 2015, Bitcoin was hitting lows. It just got out of a bull market where it peaked at around $1,200 and it came all the way down to around 180 bucks. And you can see after that, this actually had a little bit of a rebound here going up until 2018, 2019, and Bitcoin actually went into a bull run for a couple of years back here from 2015 all the way up here to 2018, 2019. That's when we peaked at around $20,000, and then we fell down to $3,800. And you can see that right here after the PMI chart peaked right here around 2018. It kind of came down here in 2019, and Bitcoin followed that exactly. And we see the same thing here going into 2021, and where we are currently at. Bitcoin has sold off here over the past year and a half after the PMI went on a tear here. So that's what Lyn was talking about. Let's go ahead and see what else she has to say about BTC.
I was doing research to figure out what is most correlated with Bitcoin. I kind of touched on multiple areas. Like one is that economic rate of change, like PMI, or a set of indicators that kind of resemble something like PMI. Is the economy accelerating or decelerating? That is a pretty strong. And the reason those both work is that both liquidity and the quads, or the economic cycle, are rather correlated in themselves, because liquidity is kind of a big component that helps drive economic cycles one way or another. And so you kind of get a slight difference on the exact timing. But yeah, essentially, I do think that this recent liquidity pump was a big factor. Now, obviously, Bitcoin has been rising before you got this big March liquidity injection, which is obviously, it's different than QE, but it's still a pro-liquidity effect while it was happening. And so, I think part of it was that, Bitcoin was so beaten down by the whole, crypto fraud, FTX, all that stuff that happened last year. So if anything, it was earlier this year, you had kind of had a partial recovery, just because you had super oversold levels. You had a lot of kind of long-term people kind of coming into the market, buying it, pulling it back up. A lot of it also was the dollar index. So, if you look at, where the dollar peaked back at that, late last year, that was roughly when you started to have domestic liquidity trend sideways. I talked about it earlier. You had the Treasury was providing liquidity that the Fed was still removing. And so if anything, that kind of is partially explains the Bitcoin move, because you had, liquidity was getting worse and worse and worse, and you had all these leverage things blow up. But then once you had that kind of liquidity start to stagnate for a period of time, it allowed the fundamental kind of longer term aspects of Bitcoin to start taking over again. But yeah, if you have liquidity roll over again here, I do think you could have Bitcoin consolidate or correct for a period of time, rather than keep going up at the same pace it has been, year to date. I think we're already kind of maybe seeing early signs of that, where we're due for a pause, due for a correction. And I think that'll be heavily tied to partially the economic cycle, partially liquidity, and then especially because both of those are inherently intertwined anyway.
Thank you guys for watching all the way to the end of the video. Really appreciate you. If you found any value, make sure to hit that like button. My name is Aaron from the Bitcoin Bros. I'm out. I'll see you guys in the next one. Have a great rest of your day.